What is fundamental analysis? Fundamental analysis is a technique to measure a company's value based on its financials and other objective metrics, as opposed to market price trends. Fundamental analysis involves examining a company's financial statements and broader economic indicators to uncover a security's intrinsic value. The result of such an analysis should give you the investment's true worth based on a company's financial health, the market, and economic conditions. Investors perform fundamental analysis to gauge whether or not to invest in a company based on its current and projected worth. Fundamental analysis looks at intrinsic factors to determine a company's value, as opposed to its current price or market trends. This approach looks beyond investor sentiment and company marketing to determine if the stock price is over or undervalued. Fundamental analysis starts by examining the company's financial statements, including the income statement, balance sheet, and statement of cash flows. Analysts look at the company's assets, debts, revenue, and other metrics and compare them with other companies in the same industry. In addition, fundamental analysis also looks at macroeconomic factors to see if the company is positioned for success. Analysts may consider gross domestic product, inflation, interest rates, industry or sector trends, and the company's competition. This approach often includes reviewing the company's business model, management effectiveness, brand awareness, and potential for growth and profitability. Fundamentals allow investors to look beyond short-term price fluctuations and focus on the underlying factors that drive a company's operations and long-term performance. The main benefit of fundamental analysis is to help quantify the value of a company and its shares. Financial statements offer hard data that reveal insights into a company's profitability, liquidity, and overall financial stability. This information, along with an assessment of the company's management team, competitive advantages, and industry trends, furnishes an objective measure of the company's value. With this knowledge, investors can make more informed decisions about buying, holding, or selling a particular stock. Fundamental analysis can also help investors identify undervalued companies. By considering a company's sales, growth, market share, and product pipeline, investors can gauge its ability to increase future profits and grow shareholder value. Value investors, in particular, look for undervalued shares relative to their fundamental potential. It can also help spot red flags and overvalued investments. By researching a company's financial health and market position, investors can determine if a company is likely to underperform or experience significant downturns. This is especially important during periods of economic uncertainty or market volatility. Where to find fundamentals for a company? Some of the most common and reliable sources for the fundamentals of a company include the following: company filings. Public companies are required to file regular reports with the Securities and Exchange Commission (SEC), such as Form 10 Annual Report, Form 10 Quarterly Report, and Form 8 Current Events Report. These filings contain detailed financial statements, management discussions and analyses, and other important information about the company. You can access these filings for free on the SEC's EDGAR database. Company website. Most publicly traded companies have an investor relations section that provides financial statements, earnings releases, investor presentations, and other relevant information for shareholders and potential investors. Earnings call transcripts can be particularly helpful since companies use them to address their soft spots for analysts. Financial platforms, Yahoo Finance, Google Finance, and MarketWatch, among others, provide financial news, analysis, and fundamental data on publicly traded companies, including financial statements, key ratios, and analyst ratings. Broker research reports. Many brokerage firms supply research reports on companies they and their affiliates cover, often with detailed fundamental analysis and investment recommendations. Financial data providers. Subscription-based financial data providers such as Bloomberg, FactSet, and Morningstar offer extensive fundamental data and analysis on companies, industries, and markets. Subscriptions are often pricey, so they are more typically used by professional investors and analysts. Industry trade journals, trade publications covering specific industries can provide valuable insights on industry trends, competitive dynamics, and company-specific developments that inform your fundamental analysis. Remember, when conducting fundamental analysis, it's essential to use several sources to get a well-rounded view of a company's financial prospects and to be aware of any potential biases or conflicts of interest in the information you are receiving. How to read a company's annual report. Reading a company's annual report is an essential part of fundamental analysis. Here's a step-by-step guide on how to read and analyze an annual report. Start with the CEO's letter to shareholders. This section gives an overview of the company's performance, key developments, and outlook from the perspective of top management. Pay attention to the tone and content of the letter, as it can give insights into the company's strategy, challenges, and prospects. Review the business description. This section describes the company's main products or services, target markets, competitive advantages, and key risks. It can help you understand the company's business model and the factors that drive its success. Analyze the management's discussion and analysis and at them, and provides a detailed discussion of the company's financial performance, including revenue and expense trends, cash flows, and key financial ratios. It also has management's perspective on the factors that affect the company's performance and outlook for the future. Examine the financial statements. The annual report has the company's audited financial statements, including the income statement, balance sheet, and statement of cash flows. Review these carefully while looking for trends in revenue, expenses, profits, assets, liabilities, and cash flows. From there, you can compute the critical financial ratios. Read the notes to the financial statements. The notes or footnotes provide additional details and explanations about the company's accounting policies, significant transactions, and other important information that may not be clear from the financial statements alone. Review the auditor's report. This provides an independent opinion on whether the financial statements fairly present the company's financial position and performance following generally accepted accounting principles. Look for any qualified opinions or disclaimers that may indicate potential issues. Analyze the company's corporate governance. The annual report often has information on the company's board of directors, executive compensation, and other corporate governance matters. Consider whether the company's governance practices align with the interests of shareholders and whether there are any red flags, such as conflicts of interest or excessive compensation. Look for additional disclosures. The annual report may include additional disclosures about legal proceedings, regulatory issues, or environmental, social, and governance factors that could impact the company's performance and reputation. A closer look at financial statements. The information in financial statements is among the most valuable about a company's financial health and performance. Here's a breakdown of what you can learn from each one. Income statement. This shows how much money a company is making, revenue, how much they are spending, expenses, and what's left over, profit or loss. By looking at trends in revenue and expenses over time, you can get a sense of whether the company is growing or struggling. You can also calculate important ratios like the company's profit margin, which tells you how much of each dollar in sales the company gets to keep as profit. Balance sheet. This gives you a snapshot of what a company owns, assets, what it owes, liabilities, and what is left over, shareholders' equity. This can help you assess a company's financial stability and liquidity. For example, if a company has a lot more assets than liabilities, that's generally a good sign. You can also look at how much debt the company has relative to its equity to understand its financial leverage and risk. Statement of cash flows. This shows how much cash is coming in and going out of the company over a given period. It's broken down into three main categories. Cash from operations, the money generated by the company's core business activities. cash from investing, the money spent or earned from investments not related to the core business, and cash from financing, the money raised or paid out and used to fund the business. By looking at a company's cash flows, you can better understand its ability to generate cash, pay its bills, and invest in growth. The cash flow statement is crucial because it's harder for a business to manipulate its cash situation. An aggressive accountant can do plenty of things to manipulate earnings, for example, but it's tough to fake cash in the bank. For this reason, some investors use the cash flow statement as a more conservative measure of a company's performance. Quantitative and qualitative fundamental analysis. The problem with defining the fundamentals is that they can cover anything related to a company's economic well-being. They can include numbers like revenue and profit, but they can also include anything from a company's market share to the quality of its management. Generally, these are grouped into two categories: quantitative and qualitative. Quantitative information that can be shown using numbers, figures, ratios, or formulas. Qualitative, rather than a quantity of something, it is its quality, standard, or nature. In this context, quantitative fundamentals are hard numbers, the measurable characteristics of a business. The most significant source of quantitative data is financial statements. The qualitative fundamentals are less tangible. They might include the quality of a company's key executives, brand name recognition, patents, and proprietary technology. Neither qualitative nor quantitative analysis is inherently better. Many analysts consider them together. Qualitative fundamentals to consider. There are certain qualitative fundamentals that analysts should always consider when analyzing a company. These include the following: the business model. What exactly does the company do? This isn't always straightforward. If a company's business model is based on selling fast food chicken, is it making its money that way, or is it coasting on royalty and franchise fees? Competitive advantage. A company's long-term success is primarily driven by its ability to maintain its competitive advantage. Competitive advantages, such as Coca-Cola Company as Co. brand name and Microsoft Corporation's theft, long domination of the personal computer operating system, create a moat around a business, allowing it to keep competitors at bay and enjoy growth and profits. Management team. Some think management is the most important criterion for investing in a company. This makes sense. Even the best business model is doomed if the company's leaders fail to execute the plan properly. While it's hard for retail investors to meet and truly evaluate managers, you can look at the corporate website and check the resumes of the top brass and the board members. How well did they do in previous jobs? Have they been unloading a lot of their stock shares lately? Corporate governance and board structure. These are provided by the policies within an organization that indicate the relationships and responsibilities among management, directors, and stakeholders. These policies are defined and determined in the company charter, its bylaws, and corporate laws and regulations. You want to do business with a company that is run ethically, fairly, transparently, and efficiently. Note whether management respects shareholder rights and shareholder interests. Ensure their communications to shareholders are transparent and understandable. If you don't get it, if there are major issues surround the company and they aren't addressed, it's not a sign that they have good answers for you. Industry trends. It's also important to consider a company's industry, its customer base, market share among firms, industry-wide growth, competition, regulation, and business cycles. Learning how the industry works will give an investor a deeper understanding of a company's financial health. Stakeholder satisfaction. Employees, managers, customers, suppliers, investors, and other stakeholders should all have positive views on the company and its prospects. Without that, a company's brand equity and image can suffer, which can lead to fewer sales, lower profits, and flagging share prices.